Okay, everybody, we're here again. This is a video I'm putting together about a buy right strategies. And a buy right is one of the simplest ways you can create income the day you enter the stock position. So you buy the shares, you sell a covered call, and right away you've created income day one. And this is what this video is about, the buy right. Just a quick reminder before we begin, this video is for educational and informational purposes only. This is not financial advice. Anytime you're dealing with investing or options, make sure you do your own research and make your own decisions. So, what the heck is a buy right? At its core, it's very simple. So, you buy 100 shares of a stock and then you sell a covered call against those shares. That covered call, it brings in premium right away. That's your income. So instead of just entering a stock and waiting, you're going to enter the position already creating income. So that's the buy right strategy. And a lot of times your broker will actually have a buy right strategy, kind of a drop down in their drop down menu. I know Fidelity has it. I actually don't use that, but I know that there are brokers out there that actually have a buy right as a strategy. So that's what the buy right is in its essence. There are a few reasons investors like this strategy. First, you get paid up front. Second, that premium lowers your effective cost basis. Third, you already have a defined sales zone through the strike price. So it could feel a little bit like creating your own dividend because you're bringing in income now instead of waiting. So in general, this works best in neutral to mild bullish setups where controlled upside is completely fine. You don't want to buy these in rips or sell covered calls in rips, and you don't want to sell covered calls when you think the stock price might be going lower. There are really two practical ways to use this. The first is the classic buy right. That's where you buy shares and you sell a covered call immediately. And then the second is what I call a delayed buy right. That means you buy the shares first, you wait a little before selling the call because you think the timing may improve. Same strategy, it's just different timing. This is why I sometimes wait before selling that call. If I think momentum is building, I may buy the shares first and let the stock move a little bit before I layer in that covered call. That can help reduce how much upside I cap too early. So it can also improve the timing of the call itself. So in certain situations, I like the stock to move first and then adding that income layer after. So why not just buy the stock and leave it at that? Because the buy and hold, most of your return depends on appreciation of the stock alone. A buy rate adds a second layer of return potential. Now, you still want the stock to work, of course, but you also want to have premium income working for you. So that combination of stock movement plus premium can create a better total return setup than just simply asking the stock to do all the work by itself. So a buy rate usually makes the most sense when the stock fits a very specific kind of setup. So I want to own the stock, first of all. I want some bullishness, but not the kind where I think it's just going to rip and explode. I want decent premium, and I like having resistance overhead because that helps define the exit. To me, controlled bullishness is really the sweet spot here. Good stock, good premium, defined exit. That's what makes a strong buy right candidate. Now here's the part that really matters. A buy right creates immediate income, but it doesn't remove the risk. You could still cap your upside if the stock runs too fast, too far. If the stock can also stall or fail, because at the end of the day, you still own shares. So this is where it's not free money. The premium helps. It lowers your cost base a little, but it doesn't eliminate the downside risk. A bad stock selection can really hurt. So this is where you really want to make sure you're picking the right stock. All right, so here's a simple example. So let's say a stock is trading at $100. So you buy 100 shares at $100, and then you sell a covered call at the 102 strike price. For doing that, you collect $2 in premium. Now, if the shares get called away at 102, you make $200 from the stock appreciation, plus you make another $200 from the premium you collected, which gives you $400 before fees. Here's how I personally like using it. For me, a buy rate is usually a short-term income trade with a planned exit. I'll often start early in the week. Sometimes I'll wait before selling the call if I think the timing can improve. So usually it's a short hold, and a lot of times I'm perfectly happy getting assigned. I mean, that's actually the whole point of this. So that's the mindset for me. Define risk, income collected, move on. A lot of times I'll buy the shares on Monday, Tuesday, even Wednesday, and then I'll sell the covered call on Wednesday or Thursday, depending on the stock, how it's moving. And that's for a Friday expiration. So you're looking at 1 or 2 days sometimes that I'm putting this trade on for. It's not exactly a day trade, but you're putting it on, and the idea is you want the shares to be called away on Friday with you making your maximum amount, which in the simple case that we had earlier was $400. So when you step back, this is really what a buy rate is all about. Immediate income, lower your cost basis, defined exit. It's not about catching every last dollar of upside. It's about building a smarter, income-focused stock trade from the start. That's why I like it. It gives you structure for the trade, and it pays you right away for taking that position. So understanding the concept is one thing. Seeing a real trade is where it really starts to click. So in the next video, I'm going to show you how a real buy rate example is done, including the entry, the call sale, the exit plan, so you can see how this looks in an actual trade instead of just in theory. Thanks for watching. If you're trying to learn practical income strategies, real trade examples, and step-by-step investing content, make sure you like, subscribe, and share the channel. I really appreciate it. Take care.